Welcome back to IFRS, International Financial Reporting Standards. In this video, we will cover IFRS 9 to IFRS 19 in a simple and detailed way. These standards are an important part of financial reporting, and this video will help you understand them in step by step. If you haven't yet watched my previous video of IFRS 1 to IFRS 8, you can now watch that video by clicking the I button. Make sure you watch both parts to get a complete and better understanding of the IFRS series. Now, let's start with the IFRS 9, Financial Instruments. The objective of this IFRS is to establish principles for the financial reporting of financial assets and financial liabilities, so that useful information is provided about the amount, timing, and uncertainty of future cash flows arising from financial instruments. IFRS 9 tells companies how to recognize, classify, measure, and account for financial instruments, mainly financial assets like loans, investments, and financial liabilities like borrowings. Key areas of IFRS 9: classification and measurement. Financial assets are classified based on business model, how company manages assets, and cash flow characteristics. They are measured at amortized cost and fair value, FVOCI or FVTPL. 2. Impairment, expected credit loss model. Instead of waiting for loss to occur, IFRS 9 requires companies to estimate future losses in advance. This is called expected credit loss, ECL. 3. Hedge accounting aligns accounting with risk management activities like hedging in foreign exchange risk. Let's understand with the example. Suppose a company gives a loan of $1,000 to a customer. In old method, before IFRS 9, loss recorded only when customer defaults. Under IFRS 9, company estimates possible loss in advance. Assume expected loss equals $100. Accounting treatment. Loan shown equals $1,000 less expected loss equals $100. Net value in books equals $900. In particular, the IFRS 9 requires a financial assets to be classified and measured on the basis of the entity's business model for managing the assets and the contractual cash flow characteristics of the financial asset. Certain financial assets to be measured at amortized cost, fair value through other comprehensive income, or fair value through profit or loss, depending on their classification. Financial liabilities to be generally measured at amortized cost, except for those measured at fair value through profit or loss. a forward-looking expected credit loss model to be used for the impairment of financial assets and certain other financial instruments. Hedge accounting requirements to be aligned more closely with risk management activities, allowing entities to better reflect the effects of hedging in their financial statements. IFRS 9 makes accounting more realistic and proactive. It focuses on early recognition of risk. It improves financial transparency. IFRS 10 Consolidated Financial Statements. The objective of this IFRS 10 is to set out the principles for preparing consolidated financial statements. When one entity controls one or more other entities, it replaces the old idea of consolidation based only on ownership and instead uses control as the main basis for consolidation. IFRS 10 explains when and how a company should prepare consolidated financial statements. By including another company as subsidiary. In simple words, IFRS 10 says if one company controls another company, it must show both as one single entity in financial statements. Core concept of control. A company controls another company when it has power over the investee, decision-making rights. 2. Exposure to variable returns, profits and losses. And 3. Ability to use power to affect returns. All three must exist. Let's understand with the simple example. Suppose Company A owns 60% shares of Company B. Then the IFRS 10 say, since Company A has majority voting power, it can also control decisions, making power. Company B becomes a subsidiary of Company A. IFRS 10 explains accounting treatment. Company A will combine assets, liabilities, income, and expenses of Company B and prepare consolidated financial statements. Even though Company A owns 60% of Company B, but it shows 100% in their financial statement. Remaining 40% is shown as non-controlling interest, NCI. Why is IFRS 10 important? It shows the true financial position of a group. It prevents hiding of losses in subsidiaries. It helps investors to understand the real size and performance. IFRS 11 Joint Arrangements. The objective of this, IFRS 11, is to establish principles for financial reporting by entities that have an interest in arrangements that are jointly controlled by two or more parties. IFRS 11 explains how to account for situations where two or more parties jointly control a business arrangement. Core concept of joint control. Joint control means decisions require agreement of all parties involved. No single entity can control a loan. There are two types of joint arrangements. Number 1, joint operation. In joint operation, parties have direct rights to assets and obligations for liabilities. Accounting treatment in joint operation. Each company must record its share of assets, liabilities, income, and expenses. Number 2, joint venture. In joint venture, parties have rights to net assets only, not direct assets. Accounting treatment in joint venture. It must use equity method. It's show investment as a single line item. Let's understand the simple example of joint operation. Company A and Company B jointly operate a factory. Company A owns 50%. Company B owns 50%. Factory assets, $100,000. Company A records $50,000 as assets. Share of expenses and income. Company B also records $50,000 as assets. Share of expenses and income. Now, let's understand the example of joint venture. In this case, companies share net profit only, not direct assets and liabilities. Company A and Company B create a new company, joint venture. Company A invests $50,000 in joint venture. A does not record individual assets. It shows investment in joint venture equals $50,000. In simple words, IFRS 11 says, if a Company A and Company B start a project together, and they share assets and liabilities, it's called joint operation. If they share only profit, then it's called joint venture. Why IFRS 11 is important? It gives clarity on shared business arrangements. It avoids confusion in accounting treatment. It shows correct financial position and performance. IFRS 12. Disclosure of interests in other entities. The objective of this, IFRS 12, is to require an entity to disclose information that enables users of financial statements to evaluate A, the nature and risks associated with its interests in other entities. B, the effects of those interests on its financial position, financial performance, and cash flows. IFRS 12 is all about disclosure. It tells companies what information they must reveal about their interest in other entities. IFRS 12 is all about transparency. So, users of financial statements clearly understand where the company has invested, what risks are involved, how those investments affect financial position. Key disclosures required in IFRS 12. Number 1. Significant judgments. How the company decided whether it controls another entity and whether it has joint control or significant influence. Number 2. Interests in subsidiaries. It must require to disclose list of subsidiaries, ownership percentage, details of non-controlling interest, NCI, restrictions on transferring funds. Number 3. Joint arrangements and associates. It's must require to disclose nature of relationship, financial summary, accounting method used. Number 4. Unconsolidated structured entities. It's also required to disclose details of entities not included in consolidation, risks involved. Let's understand with simple example. Suppose Company A owns 70% of Company B. It has 50% in a joint venture. Under IFRS 12, Company A must disclose why Company B is treated as a subsidiary, details of remaining 30%, NCI, information about the joint venture, any risks involved. IFRS 12 does not tell you how to record investment. It tells you what information you must disclose about them in your financial statements. In simple words, IFRS 12 says, does not change accounting methods like IFRS 10 and IFRS 11. Instead, it ensures transparency by requiring detailed notes in financial statements. How IFRS 12 connects with other IFRSs. IFRS 10 tells when to consolidate. IFRS 11 tells how to account for joint control. IFRS 12 tells what to disclose about all these. Why IFRS 12 is important. It improves transparency. It helps investors understand hidden risks. It gives complete picture of group structure. IFRS 13. Fair value measurement. The objective of this, IFRS 13, is to define fair value, set out a framework for measuring fair value, and require disclosures about fair value measurements. What is fair value? Fair value is a price to sell an asset or transfer a liability in an orderly market transaction. IFRS 13 says fair value is a market-based value, not a company-specific. It is based on current market conditions. Key concepts of IFRS 13. Number 1. Exit price concept. In this concept, value is based on selling price, not purchase price. Number 2. Principal or most advantageous market. Use price from main market, principal, or best possible market,
most advantageous.
Number 3, highest and best use for non-financial assets.
Asset value depends on its most profitable use.
IFRS 13 uses fair value hierarchy with 3 levels of inputs.
Level 1. Quoted prices in active markets. For example, stock market price.
Level 2. Observable inputs. Indirect market data. For example, similar asset prices.
Level 3. Unobservable inputs. For example, estimates or assumptions. Let's understand with simple example. Suppose a company owns shares. Its market price equals $100 per share. Under IFRS 13, fair value equals $100 as per level 1 input. Let's understand one more example. If no market price available, similar asset value equals $90. Fair value equals $90 as per level 2 input. In simple words, IFRS 13 says, fair market price. It is the price in an open market between willing buyers and sellers. Agree to make a transaction. Why IFRS 13 important? It gives accurate market value to the entity. It ensures consistency in valuation, reporting. It improves transparency for investors. IFRS 14. Regulatory deferral accounts. The objective of this, IFRS 14, is to specify the financial reporting requirements for regulatory deferral account balances that arise when an entity is subject to rate regulation. IFRS 14 is a temporary standard that applies to companies operating in rate-regulated industries like electricity, gas, and water. IFRS 14 allows certain companies to continue using their previous accounting policies for regulatory deferral accounts when they first adopt IFRS. In simple words, IFRS 14 says when prices are controlled by a regulator like government, companies, it may delay for recovering of costs. Or sometimes it's recover extra amounts in the future. These differences are called regulatory deferral accounts. They arise when regulator sets price, tariff. Actual cost not equal allowed revenue. Differences recorded and adjusted in future pricing. IFRS 14 allows first-time IFRS adopters to continue recognizing these deferral balances. Requires separate presentation in financial statements. Let's understand with simple example. Suppose electricity company. Cost equals $100,000. Regulatory authorities allows recovery equals $90,000. Shortfall becomes $10,000. Accounting treatment. This $10,000 is recorded as a regulatory deferral asset. It will be recovered in future tariffs.
In opposite case, if company recovers extra $10,000, it becomes a regulatory deferral liability. Accounting treatment. It's shown separately in balance sheet, profit and loss accounts, not mixed with normal assets and liabilities. It is only for first-time adopters of IFRS. Existing IFRS users cannot start using it. Why IFRS 14 is important? It helps companies smooth transition to IFRS. It avoids sudden changes in profit and losses. It maintains consistency with previous reporting. IFRS 15. Revenue from contracts with customers. The objective of this IFRS 15 is to establish principles for reporting useful information about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with a customer. IFRS 15 tells companies when and how to recognize revenue based on the transfer of goods or services to customers using a clear step-by-step approach. The 5-step model is very important in IFRS 15. Number 1, identify the contract. Agreement between company and customer. Number 2, identify performance obligations. What goods and services are promised? Number 3, determine transaction price. How much money will be received? Number 4, allocate price. Divide price among different obligations. Number 5, recognize revenue when each obligation is satisfied. In simple words, IFRS 15 explains how and when a company should recognize revenue, sales income. Let's understand with simple example. A company sells mobile phone plus 1-year service plan. Total price $1,000. Let's break it stepwise. Phone value equals $800. Service value equals $200. Total price equals $1,000. Revenue recognition. $800 recognized immediately after phone delivered. $200 recognized over 1 year after. Service provided. Key concept: transfer of control. Revenue is recorded when customer gets control of goods and services. It can use and benefit from them, not just when cash is received. IFRS 15 provides a standardized revenue model. Its focus is performance and control. It improves consistency across the industries. Why IFRS 15 is important? It's provided standardizes revenue recognition. It prevents manipulation of income. It improves comparability between companies. IFRS 16 Leases.
The objective of this, IFRS 16, is to set out the principles for the recognition, measurement, presentation, and disclosure of leases, ensuring that the entities provide relevant information about leasing transactions. IFRS 16 requires companies to show leases on the balance sheet. Instead of keeping them off balance sheet, giving a clearer picture of their financial obligations. In simple words, IFRS 16 explains how companies should account for leases, renting assets like buildings, vehicles, and equipment. In very simple meaning, if a company takes something on rent, how should it show it? In accounts. Core concept. When a company takes an asset on lease, it gets the right to use the asset. It has an obligation to pay rent. So both must be recorded in account. Let's understand with simple example. A company takes a building on lease. Rent equals $1,000 per month. Lease period equals 3 years. Under IFRS 16, record asset, right to use, building. Liability, total lease payments. During the year, depreciate the asset, pay rent, reduce liability, interest expense on liability. Accounting impact on balance sheet. Assets increases. Liabilities increases. Profit and loss accounts shows depreciation plus interest instead of rent expense. Why IFRS 16 is important? It shows true financial position. It increases transparency. It avoids hiding liabilities. IFRS 4 was the earlier standard, and it has now been replaced by the IFRS 17. Insurance contracts. The objective of this, IFRS 17, is to establish principles for the recognition, measurement, presentation, and disclosure of insurance contracts, ensuring that entities provide relevant and faithfully representative information about those contracts, like policies, profits, and liabilities. In simple words, IFRS 17 ensures that insurance companies report their contracts using current, realistic values and recognize profits gradually as they provide insurance services. It helps improving transparency and comparability. IFRS 17 provides a comprehensive framework for accounting of insurance contracts. It tells insurance companies, receive premiums today, but pay claims in the future. IFRS 17 ensures that profit is recognized over time. Not all profit is shown immediately. Core concept of current value measurement. Insurance liabilities are measured based on expected future cash flows, time value of money, discounting, risk adjustment, profit margin, CSM.
Important term of CSM, Contractual Service Margin. CSM equals unrecognized profit. Profit is not recorded immediately. It is released over the policy period. Measurement model. Insurance liability includes 1. Expected future cash outflows, claims and expenses. 2. Discounting, present value. 3. Risk adjustment. 4. CSM, profit to be recognized later. Let's understand with simple example. Suppose an insurance company received premium equals $100,000. Expected claims equals $70,000. Profit equals $30,000. Under IFRS 17, do not show $30,000 profit immediately. Instead, record it as CSM. Recognize profit gradually over policy period. Impact on balance sheet. Insurance liability shown at current value. Profit and loss. Profit recognized over time, not upfront. Why IFRS 17 is important? It brings transparency in insurance reporting. It makes companies comparable globally. It avoids showing profits too early. IFRS 18. Presentation and disclosure in financial statements. The objective of this, IFRS 18, is to establish principles for the presentation and disclosure of information in financial statements, with a focus on improving comparability, transparency, and consistency of financial performance and reporting. IFRS 18 is a new standard issued in 2024, and it's already existing standard that improves how companies present and disclose information in financial statements, especially the profit and loss statement. IFRS 18 replaces parts of IAS 1 and focuses on better structure, consistency, and transparency. In simple words, IFRS 18 tells companies how to present income and expenses clearly so users can easily analyze performance. Key features of IFRS 18. 1. New structure of profit and loss. Income and expenses are grouped into categories like operating, main business activities, investing, returns from investments, financing, interest, loans, etc. It makes financial statements more comparable. 2. Defined subtotals. IFRS 18 introduces important subtotals like operating profit. This helps investors to understand core business performance separately. 3. Management performance measures, MPMs. Companies often show their own metrics like adjusted profit, EBITDA. IFRS 18 requires companies clear explanation, and reconciliation with actual numbers. 4. Improved disclosure, more transparency in notes, better breakdown of expenses, clear classification of rules. Let's understand with simple example. Suppose a company reports sales $500,000, expenses $300,000, interest $50,000. Under IFRS 18, operating profit equals $200,000. Financing cost, shown separately, $50,000. Clear separation improves understanding. Why IFRS 18 is important? It makes financial statements easier to read. It improves comparability between companies. It reduces confusion from customized metrics. IFRS 19. Subsidiaries without public accountability disclosures. The objective of this, IFRS 19, is to specify the disclosure requirements. That an eligible entity is permitted to apply instead of the disclosure requirements in other IFRS accounting standards. In simple words, IFRS 19 allows eligible subsidiaries to prepare IFRS financial statements with fewer disclosure requirements. That saves time, cost, reporting effort. It's reducing complexity and reporting costs while still following full IFRS accounting rules. Who can use IFRS 19? A subsidiary can apply IFRS 19 if it does not have public accountability, means its shares or debt are not publicly traded. It is not a bank, insurance company, etc. And its parent company prepares consolidated IFRS financial statements. Important points of IFRS 19. It changes mainly disclosure requirements. It does not change recognition, measurement, accounting principles. Let's understand with simple example. Suppose Company A is a large listed parent company. Company B is its private subsidiary. Company B uses IFRS accounting rules, but only under IFRS 19 it can avoid some detailed disclosures. Result: it helps to make simpler financial statements and lower compliance cost. Why IFRS 19 is important? It reduces reporting burden. It saves time and cost. It maintains quality of financial reporting. Thank you for watching, guys. If you found this video helpful, hit that like button and leave your valuable advice below. And please subscribe to our YouTube channel so you never miss an update, and share it with your friends.